All right, so I wanted to talk to you guys today about the second largest bank failure in U.S. history. So, what happened is yesterday, the Silicon Valley Bank, based out of Santa Clara, California, failed and was taken over by the FDIC, the Federal Deposit Insurance Corporation, for those of you that don't know. So this failure comes just 2 days after another bank, Silvergate Capital, which was one of the top crypto market banks, it failed and announced they were going to liquidate all their assets and wind down that bank. Now, although Silvergate's failure wasn't really surprising, what was the effect of what happened with SVB, or Silicon Valley Bank. And that kind of led to that failure because Silicon Valley Bank's top holdings were the tech companies, which we've seen a lot of cracks in the tech companies lately with all these layoffs that are occurring and the different logistics problems that they've been having with a lot of the chips and things like that coming from China. And the other thing is their other number one holding was in crypto. So between tech and crypto, this bank was having troubles. They tried to raise capital to save the bank. They were unable to do so. They ran up against the clock. And within a 48-hour period, the FDIC came in and shut them down yesterday. I saw a report today that there are people lined up outside this bank trying to get their money out. Picture the movie that James Stewart was in back in the 1930s, It's a Wonderful Life, when they had to shut down their savings and loan bank when the Great Depression started. So that's kind of what I'm picturing. I haven't seen images of it, but you can imagine what it looks like. So what I want to talk about is, what does this mean for the commercial real estate industry, really specifically for multifamily? But before I do that, I also want to mention that this is the second largest failure in U.S. history by a bank, to the tune of $209 billion in assets. The one that beat it was in 2008. If you guys remember, Washington Mutual failed in 2008. It was $307 billion. And of course, that led to the failure of Bear Stearns and what was the name of the other one? Anyway, the big bank failures that occurred and the financial institutions that started the big financial crisis. I'm not saying that's going to happen this time, but we're under the same economic conditions right now. So without talking about all that, let's talk about what does this mean for the CRE industry. So what I'm going to do is I'm pulling a lot of this information from Trepp, which follows the financial capital markets. And so I'm going to read from their article, and you can, if you want this article, just let me know below and I will send you the link to it. So they say the failure of SVB and the fallout are somewhat ironic in that the Fed wants the economy to cool and financial conditions to tighten to lower inflation, but obviously not at the expense of financial stability. However, this event will cause financial conditions to tighten if, big word here, if lenders pull back from the market and lending liquidity is constrained. So that can happen with a big event like this. They're not saying it's going to, but the potential is definitely there. This event was exactly the kind of failure the market has been worried about for the past 3 to 6 months, given the pace of rate hikes and the kind of risk that's been building in other sectors. Specifically, there's been concerns that crypto losses and the tech wreck could lead to credit concerns in the financial sector, but that hasn't materialized, at least not until SVB's failure. As we saw in 2008, credit issues in the financial sector can lead to what's called the contagion effect, where shocks or disturbances in each sector, here the financial sector, create a chain reaction that spreads to other sectors and ultimately increases volatility and risk across the broader economy. This is ultimately why it seems almost inevitable that CRE credit spreads will increase and lending liquidity will decrease over the short run, regardless of any intervention from the Fed or FDIC because it takes some time for the market to pull back from and stop the fallout from a contagion effect type event such as SVB's failure. Now, there is a silver lining to this. So the silver lining is that all the doom and gloom is that when risk increases, as it has in recent days, investors flock to safe investments like treasury bonds, which push down their yield and increase their price. If you noticed yesterday, during the after the announcement of SVB's collapse, if you've been following the financial markets, the bond market shot down. So 10-year treasury went down 22 basis points yesterday. So it's back down to about 3.7%. So in the short run, this can lower interest rates from this effect because due to the volatility in the market that this may cause, investors will flock to safety. So they go buy bonds. This in turn should result in lower losses on bond sales. A minor positive, but a positive nonetheless, especially for commercial real estate borrowers, in that this means that mortgage rates will decrease. There are still several questions that don't have an easy or immediate answer, however, such as whether lending liquidity is drying up, how lending spreads are reacting, and how long this fallout will last. Okay, so that is from Trepp. Now, I know you have one question here, and that is, what the heck is a CRE credit spread? So let's define that. So a credit spread is the difference in yield between two bonds or other debt instruments with different credit ratings or risk profiles. A commercial real estate credit spread specifically refers to the difference in yield between two commercial real estate loans with different credit ratings or, again, risk profiles. For example, if a commercial real estate loan is issued by a high-rated borrower, has a yield of 4%, and similar loan issued by a low-rated borrower, it'll have a yield of 6%. Then the credit spread between the two loans would be 2%. The difference in yield reflects the additional risk associated with the lower-rated borrower's loan. So as you can see that with the financial situation that is occurring and the liquidity tightening up, those risk profile spreads will get larger, meaning that these lenders will still give whatever the market rate is for their best borrowers, but if you have any risk whatsoever, those interest rates are going to go higher and higher. So although we've got lowering of interest rates, that will be good for our good borrowers, but if you're new to the industry or if you've had some troubles or you have to struggle to find other people to help you do this loan, your interest rate is probably going to increase, not decrease, because of the risk spread profile from this occurring. So what does this mean for us? Well, if we look at this in the short term, again, we'll see some lowering of rates initially. We'll see that as early as next week. Will this continue to create a snowball effect? We don't have the answer to that yet. It is still too early. I want you to pay attention to what's going on, watch the financial markets, and make sure that you understand what's happening, because this is exactly how the 2008 collapse started. So we need to really start paying attention. As far as borrowing is concerned, if you're on a bridge facility right now and you've been worried about refinancing it or trying to get out of it, with the lowering of interest rates next week because of this happening, now I don't know how far they're going to go down. Remember, in 2 weeks, we've got an interest rate hike coming. I don't know how this is going to affect that interest rate hike or if it will or not. It'll be very interesting to see what comes out next week, so you need to be paying attention to that. So some of you, yesterday I reported we have this big foreclosure crisis coming. This could affect that. Now, it can either accelerate it or decelerate it if the credit risks spread out over a longer period of time. So we'll see. We'll see how this goes. This may spook the Fed. The Fed may reverse what they're doing. I think they would be crazy to do so, even though my multifamily friends right now are telling me I'm crazy for saying that. But we got to save the middle class. And just because you bought a property wrong isn't the middle class's fault. That's your fault. So you'll have to deal with those consequences as they come. So I'm not sure that the Fed will knee-jerk react to this, but this is the kind of event that the Fed does knee-jerk react to. So we'll see how that goes. Any questions, please put them in the chat below. I can't see what it is right now. I don't even know how many people are on. I guess I can go look. I pulled away so I could read this article. Oh, wow. I got a whole whopping 3 people watching, which is fine. I don't care. So if you guys have any questions about this, let me know below. I'll try to answer them. I do have to teach in about an hour. And then I'll also send you the article if you want the article. So just let me know. So enjoy your weekend and pay attention to what's going on. Things are starting to happen.